Okay, today we'll attempt to explain to you some of the buzzwords which get used in currency, and the first one among that is carry trade. Now, carry trade is a strategy used by traders where you borrow in a currency which has a low interest rate, like US for example, and you invest that money, the borrowed money, in a currency which is giving you a high interest rate. So typically it would mean something like, let's take an example, you borrow from the US. In US rate, you could probably borrow at 2%, for example, and you borrow from there at 2%. And you come to India and with that money, convert it to rupees and you invest it at 10%. So what that means is you borrowed at 2, invested at 10, and therefore you would get potentially a return of 8% out of this. Now, it sounds like a very simple strategy because you make the interest differential. And not just that, if the rupee appreciates, then you actually can make a lot of money. Now, this is a very common practice which is done across the world in between two currencies, but it comes with its fair share of risk, like any other financial strategy. So, what could happen, for example, is that, let's take an example in fact. So, today the rupee is at 60 to the dollar. So, let us say that you borrow $1 from the US. So you borrowed $1 and it is 60 rupees. Now, where you borrowed that $1, you are paying an interest, for example, just for the sake of rounding off, let us take it at 10%. So if the interest you are paying at 10%, you are saying that 10% is what is your outflow. Now, when you come to India, again, let us assume for a second that you are going to invest it at 20%. So your net positive is 10%. 10% you borrow it at and you invest it at 20%. Now the thing is that what it actually means is that in India, this 60 over a period of 1 year will give you a 20% return, which means an additional 12 rupees. So 60 plus 12 is equal to 72. This is what you get back. Now what happens when you convert it back into dollars? Because you borrowed in dollars, so you need to return the money also in dollars. So you would give 12 rupees out of this back as interest in the, 6 rupees out of this, which is 10%, back in the US as interest, and hold this. Hold the rest of the 6 as profit. Now, it's not that easy. Because what could go wrong is exactly this, that if the rupee from 60, for example, becomes, let us assume for a second, 75. Now when it becomes 75, you will, when you convert back into dollars, then you would get for 75 rupees only $1. Which means that while you earned 12 rupees as interest, you actually ended up with probably 95 cents when you put it back. So now you have a double liability. Not only has the rupee depreciated, which makes it expensive for you to buy the dollars when you return them, but you also still need to pay the interest which you had to pay on the dollars which you have borrowed. So which could be a double whammy. So carry trade is like I said, it's a trade where you borrow from a low interest country and you put it in a high interest country. But this is only for experts because this needs to be tracked on a real-time basis. And the moment you feel that the rates are going to change adversely to your strategy, then you need to get out. So for those of you who want to, get into this, I suggest you do a lot of reading, but it's a very interesting way to dabble in the currency market.